Hello, this is Elena Ferguson, and in this video I'm going to go over Chapter 10 for Accounting 201, and the title of this chapter is Stockholders' Equity. We are finally to this chapter. I know I mentioned several times throughout this semester that we're going to learn more about stock. It's in a coming chapter. We'll learn so much. It will be wonderful. Stock, dividends, all that stuff. And now we're finally here. So here we are, ready to learn about equity. Stockholders' equity, or corporations in general, there's a ton of information in your book. Just reading about corporate form, double taxation, the other disadvantages as well as advantages. The advantages of being able to get equity, get some capital for your organization, get money in order to expand, right? So what's very important to understand is that when a corporation determines, or an organization determines to become a corporation, it means that the corporation is its own being. It no longer is owned by or falls under just the owner or the partners. It's now its own being. It has its own basically social security number. We call it an EIN number. And it can be sued. It can sue others. It forms as its own, almost as its own being, right? You would have to file your own tax return, which is the idea of double taxation. It's no longer just owned by Bob Jim, right? Or Jim Bob, I should say. I don't know, whatever. It is now owned by shareholders. So corporations are owned by whoever is the shareholder, which quite literally means they own the share of stock. And we also call them stockholders. So those two names go together. But it's quite literally that piece of paper, whoever's holding this piece of paper. Now, the paper doesn't necessarily exist anymore because we see a lot more electronic versions, but used to be that we would quite literally print this amount, whatever denomination we decided for the number of shares that we authorize, we'd print them, and whoever's holding the paper owns the organization, or owns a portion of the organization. So that's important to understand, is that we have shareholders and stockholders who actually own the organization. So let's say you decide to go what we call public. Now, there's either public or private. So if you become a corporation and you determine to go public, that means anyone and everyone can buy your shares of stock. But if you decide to stay private, that means only certain groups or certain people. So privately owned organization, family owned. Maybe you decide you're going to become a corporation because you're big enough. You need to have that limited liability for the shareholders. So you become an corporation and you decide that you're going to print the shares of stock, but only your family and certain people will be able to own the share of stock. Then that would be privately held. Or you don't sell any of the stock and it is just owned by the corporation altogether. Or it becomes public, and at that point, anyone and everyone can buy and sell the shares of stock on the stock market. So stock market used to be a really hard thing to kind of become part of. You'd have to go through a broker and do all of this. And technically, you still go through a broker, but we can do it through apps and all kinds of easy ways of buying and selling stock. So what's important to understand is that this little piece of paper that I have here looks like money, right? So this particular Johnson & Johnson one, they decided to give it that green edging that looks like a dollar bill, a $100 bill. And it's not. But it is similar to money in that it's a financial instrument. It actually has value. And we'll talk about that in just a minute. But it proves ownership, but it also can be taken somewhere and traded for value, right? So, I mean, you could go to the store and say, I need to buy my groceries. Here's a $100 bill, or here's a share of stock. Now, most grocery stores are not going to accept that, but it's a similar idea that it does have a value and it could be traded for other things, traded for money, traded for goods, whatever. But why? Why would somebody even want a share of stock? Why own stock? Well, there's a couple of different reasons to own stock. The first is maybe that you just want to own the corporation. So you want ownership of the corporation. Now, what does ownership give you? It gives you voting rights. And it basically gives you the voting rights to vote for the board of directors. You don't have the ability to make major decisions, like for Johnson & Johnson. You're not going to determine if the Band-Aid needs to be discontinued, right? You're not going to make that decision, or even decide what color Band-Aid to start manufacturing. You will just simply vote for the board of directors, and the board of directors then will vote for the executive cabinet and other major decisions, like buying other corporations or investing in large things, that kind of stuff. So you do have some ownership. And so often what happens is if somebody goes public, like the story of Zoom, it might be that they determine that the shares of stock they're not going to sell, they're not going to put out there for sale they're going to keep 51%. That way they have the voting rights. That way they can actually make the determination of who's on the board of directors. So that's often a thing, and we'll talk about that in just a second as well. But why else would we want to buy stock? For the value. We'd want to buy stock at a low price and then sell it higher. So what we do is we buy into organizations or corporations. Sometimes I call them organizations. That's just an easier umbrella to put under. But anyway, so you buy a company, you buy the value, you buy the stock, and you buy that low because you think, oh, this company is going to go big, right? So Zoom is a great story they have in here, although since this book has printed, Zoom has gone down. But they did initially sell $36 per share, and the first day the value just continued to go up. And what we mean by value is, what do others value the company at? And how do you determine value? Well, there's financial analysts that are out there looking at the financial statements. That's very important. We determine the value of a company based on looking at those 4 financial statements. And we'll look at that in chapter 12, and we'll determine, okay, does this company look like they're on the up, right? Or do I look at this company and I see, oh, they're falling. Now's not a good time to buy into them. So Zoom originally went out at $30-some, doubled by the end of the day, or close to doubled. And then by 2020, so less than 10 years later, actually I think about 10 years later. Yeah, I think it was 10 years later. The price was, I think it was almost $600 a share. And I could be completely wrong. I read it at one point, but that was the high. And of course, that was during COVID. So that was when everyone went to Zoom. Now the price is back down. I'm looking at my phone right now, and I looked it up, and it's $79-ish. So it is back kind of to where it was back in 2019 when it first came out. So, okay, so we buy it for the value. We buy low and then try to sell high, right? So that's one thing. And then the last thing that we buy dividends for, or buy shares of stock, is for dividends. Dividends are an amount of money that you receive. So it's a cash flow. Now, it's not often guaranteed that you're going to get a dividend, but we're going to talk about dividends very soon. Dividends are your share, the owner's share of the profits from the business. So in a perfect world, if the business makes $100,000 for the year and they have 100,000 shares or shareholders, then each shareholder is going to get $1, right? Obviously, a corporation is not going to distribute all of their profits. That would not be smart. So you would never really see all of that get paid out. You would see a portion, and then they keep some of that to continue to grow and expand. Okay, so those are the reasons that we buy into shares of stock now, or into organizations. Let's talk really quick before I move on to a problem, and let's talk about the shares themselves. So when a corporation becomes a corporation, they go through the articles of incorporation, and at the time of quite literally filling out the papers, they determine a number. The number they determine is the number of shares to authorize. Now, we can determine the number of shares at the very beginning, and We can later do a stock split, which will double our shares. We can do a couple of different things to kind of change that number. But for us in this class, let's just say once you determine how much is authorized, that's what we're going to go with. So an easy number would be 100,000. Let's say that this company determines that they're going to authorize 100,000 shares of stock. Now, this quite literally means they are going to print 100,000 shares of stock right here, right now. Now, I am not going to draw 100,000. Where am I at? I think that's 10, right? So I'm going to change my number and say 10. Okay, so we're going to authorize 10 shares of stock. Now, the next thing you determine, once the articles are done, you become a corporation. Now what you have to determine is, do you want to issue any of them? So you would issue shares of stock, and that would mean to sell. Remember, we learned that way on in chapter 2. So when you sell shares of stock, they will become either owned by the public or private, family or friends, whatever you determine there. The shares that you issue will become outstanding. So they're outstanding. Now, the smart thing to do would be only issue 4 of these shares. That way you're keeping 6, which means the majority vote will still be held by the organization, or maybe those shares are then given to the president or whoever formed the organization. But anyway, so you determine the number of shares outstanding. Those shares that are outstanding have the ability to vote. So you got to be careful with how many. Obviously, 4 out of 10. If you sell that to the public and then the owner holds the other 6, so the person who formed the organization, this would give them the voting power, right? They have more votes than the others. So their votes would outweigh. Okay, I don't want to talk about treasury stock yet because I'll do that in another example. But at some point from this outstanding, we would subtract treasury stock. So I'm just going to put, oh, nope, I can squeeze it in. Treasury stock. Okay. All right. We've done a lot of talking about this chapter, so much, and we're going to learn even more as we go in. Actually, wait, before I move on, I did want to zoom in. I know it's really, really hard to see, but there is a par value on this piece of paper, and that's the first thing we're going to talk about in just a minute. So let me highlight this. I'm not sure if it's going to show up, but there's the par value. It says $5 each. So this is a share, this is common stock here. So I can see that this says common stock. So let's write this down here so that we can see this. It does have a par value of $5. Okay, so what we learn is that par is the legal capital per share. It's determined at the inception. It's determined when this piece of paper is actually printed, but it does not reflect true value. So this does not equal true value. We can't print on a piece of paper an amount and think that it's going to stay, right? Because we know the market goes up and down. So that number is not going to stay. What that amount is, it's technically the amount that if this company goes under, this piece of paper hopefully is worth at least $5. The company will pay back that par. But let me just tell you, when a company goes under, chances are they're going under because they don't have money. And guess who's the last to be paid? The owners. The owners are the last to be paid. So by the time we pay out everything else, they're probably not going to get anything. Okay, our first problem is Clothing Frontiers. And we have been doing journal entries for issuing stock since chapter 2. However, we've never learned about par. So I just mentioned par a minute ago. It is legal capital per share. It's quite literally printed on the share of stock. So if I were to look at this, Clothing Frontier would be the name of the company, and on the share of stock would have some kind of par value. So it might say $1, which we're going to see in a minute. There's $1 par. It might say 100, whatever it is. Our Johnson & Johnson one said $5, right? Okay, so for our first example, though, we are saying that there is no par. And that is most common right now. organizations are not selling stock with par value printed on it because it truly doesn't relate to anything. It doesn't relate to the true value of the stock, and it doesn't mean that I'm going to give you that if I close and shut down this company. So let's take a look. January 1st. If I sell stock that has no par, then I'm quite literally, remember issue means to sell, I'm quite literally just going to have a debit to cash and a credit to common stock. And it will just be for the amount of money. Now I had 700 shares times $50 per share. So we're looking at $35,000 for the debit and the credit. What's important to note here is that I had no par. So this journal entry looks like what you guys have been doing all along. And that's because all along we've been doing no par stock. Now my T account for this would look like this. Just going to abbreviate common stock. You'll see I'll do that throughout a little bit. This first entry would be a credit of $35,000. Now the second entry, April 4th, we decide to sell more stock. Still no par, but you'll notice that my stock price has increased. So people are now seeing, hey, your company is doing good. I would like to value it a little higher. It's now $54 a share. So in total, we're collecting $5,940 just by multiplying the number of shares by the amount per share. Journal entry looks exactly like you've been doing. So I'm kind of rushing through this one. And that was April 1st. So in total, I've sold $40,940. There we go. That would be the balance in this common stock account. Okay, so that's it. Now, what happens when there's par? Now, when there's par, the world kind of changes. Now, it could say par or it could say stated value. Those two things are like AKA. It doesn't matter if your example tells you par or if it's a stated value. Stated means it wasn't printed on the piece of paper. Par would be actually printed on the piece of paper. But stated value is treated similar to par. So I'm going to do this example and I'm going to write par in here. But if your problem says stated, it would be the exact same way. All right, so let's look at this one. I would have January 1st. Cash is the same. You are still going to collect $35,000 from these new owners, these people that now own your company. So 700 shares times $50. However, when I do my credit to common stock, I can only credit this account for the par value. So I am only going to multiply this by par, which is $1, or stated. If the problem says stated, treat it the same. So that's really important. Par is the only amount that can go into this T account now. Now that we have par, that's the amount that will be the credit for this problem. So then how do you balance this out? So obviously I have $49 difference here. This is just, we'll call it the rest. So 700 shares times $49, which is the 50 minus $1. This will go into a new account called additional paid in capital. And guess what I'm going to call it from here on out? PIC, okay? PIC. Much easier. $34,300. So my entry balances. Now what's happened is I still have my common stock T account, but I also have this new PIC account. So my common stock T account only has par. So that's really important. Only par or stated, if we have stated, can go in here. So $1 is the only amount that can go in here. So I've got my January 1st $700 entry, and the rest of it is in PIC. And that's January 1st. Okay, so April 1st, similar idea. I've got cash for the full amount, $5,940. We already calculated it, but I'll write it out real quick. $110 a share, $54. That's the sales price. So that's the actual sale. Now, common stock though. The common stock account can only have par. So 110 shares times $1. And I better make sure I do that in black. Par is the only amount that can go in there. And that would be $110. So the difference, 110 shares times the difference, $53. In case you didn't see how I did the difference earlier. Take the total, the sales price, minus the par. That's how we get the 53. That's the rest. That's just the rest that I need to literally balance the equation, right? And that goes into PIC. We're going to call it PIC now, right? Okay, so my T accounts. My common stock T account looks really small now. That's okay. Because what's great about this T account is I have $810 in here. These are dollars. And I can easily divide this by par to find out how many shares I have outstanding, which is an important thing to know. And we'll get to that in our next problem. And then over here, I've got the extra amount. And that in total is $40,130. So my balance in these two accounts still add up to the same balance that I would have had if I had no par. So on the balance sheet, and let me do this in another color here. On the balance sheet, what this would look like is we would show the common stock account. I would write common stock, and I'd put the amount, $810, and then I would put additional paid in capital, or the PIC account, and I would put that $40,130, and when you add these up, it would be my total capital here of $40,940. See how that number still equals what it would have been without par, without any par value? Because we're not separating the money. Like, I still keep all of the money that I received when I sold the shares of stock. I'm just putting them in two different capital accounts instead of one. So that's why many people don't do par, because it is more tracing. It is more accounting work. Okay, for our next problem, we'll talk about dividends. So, and we'll also introduce the idea of preferred stock. So let me take a minute to explain preferred stock. So we have two different shares, or two different categories of stock. We have common stock and we have preferred stock. Now you read a lot more in your chapter, but I just want to go over a few things. Okay, both of these show ownership. So ownership and ownership. Okay, that's a similar thing. They both show ownership, which means they've got, now there's one little caveat here. Preferred stock does not vote. No vote. Okay, but common stock can vote. They both have value. They both buy the stock and can sell it. And they both have the potential for dividends. Now the difference is that under preferred stock, they are paid first. So they are preferenced. So paid first. When the owners pay, when we get paid out, we get paid first. Now we get paid dividends, and we also get paid potentially if the organization closes down or is bought by someone else. We're the first to be paid. Preferred stock. Common stock is paid last. So yeah, that's kind of a big deal there. All right, so here's what I have for this company. Nathan's Athletic Apparel, they have 2,000 shares of 5% $100 par preferred stock. So the thing about preferred stock, and I didn't write this down, I'm sorry, is that they often have, and I'm going to put this in quotes, a promised dividend. So preferred stock will have this percentage given, and that means that they are going to get a set amount for dividends. So in this example, 5% times the par, that's how we determine the amount of dividends. So I take par, which is $100, and I multiply it by the percentage, 5%, and I get $5, or $50, sorry, per share. So if I have this share of stock, this preferred share of stock, and it says this is Nathan's Athletic Apparel, right? It's a preferred share of stock. It tells me $100 par and 5%. That's great, right? And then there's a lot more. There's a lot more fine print, so I need to give myself some room. Okay, so that's what I know so far. Now, they were issued at the beginning of the 3rd year. All remaining shares are common stock, so I'll explain that in just a minute. And what happened is in the first year, the 3rd year, I should say. Sorry, this problem is kind of a weird one because they chose year 3. In year 3, they were not paid dividends. So remember how I said promised dividends? Well, you can be promised a dividend, but if the corporation does not have money to pay you, they won't pay you. And if the money that they do earn for the year is already set aside for growth or whatever, and they don't pay you, well, that's part of owning stock. There's no true guarantee that you're going to get a dividend. Dividends are not guaranteed. Now, what happens is we have cumulative and non-cumulative, which means if this share of stock, and we'll go with the first one, is cumulative, that means if I don't pay you in the 1 year, which is year 3, I will pay you later. I'll catch it up at some point. So that's a really good share of stock. That's saying that, you know what, you will get your $50. You just might not get it in the year you're supposed to. And then if it's non-cumulative, that means if you don't get it, you don't get it. Like you just miss out, right? So let's go under the first example, which is cumulative. Now this means that we will pay. So the corporation will pay old. So they will pay those old years, those prior years. Okay, so remember, year 3, 2023, whatever it is, year 3, we did not pay stock, or we did not pay dividends. Now we're in 2024, we have money. We have $22,000 to pay in dividends. So we have to determine how much to pay to who. So under the cumulative, let's do that one first. I have $22,000 to pay. What am I going to do first? Always pay preferred first. So preferred is always paid first. Now if it's cumulative, we're going to pay the old year. We are going to pay those old prior years. So I have to determine how much to pay. I know it was $50 per share, but let's go down here. $50 per share. How many shares are outstanding? 2,000 shares. So that's $10,000 total that I need. So $10,000 needed per year for preferred stock or preferred shareholders. So in 2024, I've got $22,000 to spend. I'm going to pay the old stuff first. I'm going to pay 2023s. I'm going to get them paid off. That's the old one. I do pay that one. I'm also going to pay the current year. This is the current year. I'm going to pay that. See, I've spent $20,000. Do you see how I've spent $20,000? I paid the old. I paid the new. Now the rest of the money will go to the common shareholders. So I got another $2,000 I can give to the common shareholders. Okay? That's cumulative. That means that we paid the old. Now what happens when we have non-cumulative? What do you do in that situation? Well, you don't pay the old, right? We don't pay prior years. We call it arrears. We don't pay anything in arrears. So $0 there. But we will pay the current year. So I'll pay $10,000, and I still have $22,000 in total, right? So the rest, so I pay the current year, no on the old, yes to the current year, and then the rest goes to the remaining, to all the common shareholders. So that's $12,000. So non-cumulative shares of stock, not so good for the preferred shareholders, but really good for the common shareholders. They receive whatever's left after preferred is paid. So remember, we pay preferred first, common get the rest, or the remaining. They even use the word remaining. I love that. Now, one thing that's not given in this problem, I just want to mention it. This problem's done, but I just want to mention, if you ever see a share of stock that says participating for the preferred stock, so if you see a preferred share of stock, so there's lots of fine print on these shares of stock, right? If you see the word participating, you know what that means? That means that the preferred shareholders get to participate in the rest. So they would get to share in that $12,000 or the $2,000 over here. They would get to share in that if it's participating. Now, in this example, it's not participating, so I don't want to confuse you there, but if they were participating, they would get to share in the rest of the amount. All right, let's do some journal entries with dividends. Okay, so this is Italian Stallion, and I want to set this one up really nice. So let's go ahead and start with, off to the side here, I want to keep track of the shares outstanding. So this is numbers, not dollars. I want to keep track of the shares outstanding. And this is a really big tip for you to do for your homework as well. So we're going to keep track of the shares outstanding over here, right next to all of the transactions. I'm going to have common and preferred. I don't have treasury stock for this problem, so we'll do that in a future problem. Okay, so here we go. Common and preferred. Okay, so, all right, here's what I got. I've got several transactions. I'm going to sell common. I'm going to sell preferred. And then I'm going to do the 3 dates related to a dividend. So let's start with the first journal entry, which is February 1st. And I'm going to issue or sell 6,000 shares of no par common stock. Yay, that's the easiest, right? Okay, so debit cash, and it's, let's underline this, 6,000, no par, $16 a share. So I'm going to write down 6,000 shares times 16, which is the price or the sales price. And that's a total of 96,000. So I will debit cash and I will credit common stock. There's no par, so I'll still make a little note there. No par, so I don't have to worry about that. No, so there's no pick. There's no par, there's no pick. All right, the next transaction is May 15th. Now this one is preferred stock. It's our first time doing preferred stock, but really the only difference is instead of the title of the stock account being common, it will now be preferred stock. That's the only difference. So let's debit cash for the full amount. We're selling 700 shares. It's got a par value of $13 a share. The percentage is given there too. I don't need to do anything with the percentage right now, but I'll do it in just a second. So for now, just take the number of shares, 700 shares, and multiply it by the sales price. So that sales price, $13. That's my cash amount. So $9,100. Now the next account is called preferred stock. It's our first time using it, but it's okay. It looks just like common stock. It's a credit balance, equity account. It's just like common stock. This one, I can only put my par value in. So I gotta multiply this by 10, which is the par. So only par can go in this amount. And that entry will be, that entry will be 7,000 credit. Okay, so we're off, right? Our journal entry is not correct. That's because we've got, that's because we've got a difference of $3. That is the rest. Okay, and that will go to that PIC account. So I am just going to call it PIC, but it is technically, the title is Additional Paid in Capital. And actually, I know your book calls it that, but the real long one is Additional Paid in Capital in Excess of Par. So that's the real account name, but we'll go with PIC. And that amount is $2,100. Okay, so we've done 2 entries. We've already done entries similar to that in the past, so I'm sure you're feeling pretty good with that. Now let's talk about dividends. Dividends have 3 very important dates. So these are our 3 dividend dates. And let's see. Oh, you know what? I said we were going to keep track of the shares outstanding and we didn't do it yet. So let's go back. Let's do these last 2 entries. Shares. How many shares did we distribute on February 1st? Well, we did 6,000 common stock on February 1st, I'm sorry. And then preferred, we didn't have any. And then on May 15th, we did have 700 shares on for preferred. So 515 there. Okay. So now we're all caught up. So it's important that I keep track of the number of shares outstanding because as I get into these dividend entries, we need to know. So we've got 6,000 common, 700, and these are my balances, shares. So these are not dollar amounts, these are shares outstanding. Okay, now back to what I was just mentioning is what do we do with these dividend dates? So there's 3 dividend dates. The first date is the date of declaration, the date that we declare that we're going to pay a dividend. Now we declare the dividend, the board determines, it's all approved, the board determines it, and they determine how much and on what date will be the date of record. And then of course we go through the paperwork to actually cut the checks and get it sent, right? So the date of record, because we know shares of stock can be traded and handed off from one person to another person and it kind of goes crazy, right? We have to determine at the end of the day on this very particular day, which for this problem is October 15th, that will be the date of record. Whoever holds that share of stock, that will be the person who receives my funds, my check or my electronic funds. Okay, so that's the second date, the date of record. And then the last date is the date of payment. And that's a pretty easy date. We'll see that in just a second. All right, so let's do these. Declaring the cash dividend, it's $1.25 per share to all stockholders. So that's kind of unusual that they lump together common and preferred just in reading the problem. Technically, preferred would be paid first and common would be paid second. It's fine that they're paid the same amount, but just so that we understand, technically preferred is paid first and common is paid second. So even the journal entry can be one entry, but usually the calculation needs to be done in that order. So let's talk about the preferred shares of stock. Now, yes, they just gave us the amount for the problem and you could just do your entries and be done with it. But I just want to make sure we understand dividends. So dividends are first paid to preferred. First pay preferred stock. Now, how do you pay preferred stock? You take their par value, which is 10, multiply it by the percentage, 12.5%, and I know we've already done this once, and then you'll get an amount. And it's $1.25 per shareholder. So I'll just put share. So you see, we'll pay the dividend, we'll pay preferred first, and we'll pay them $1.25, right? And then second, we'll pay common stock. And they already told us the amount is just going to be $1.25. It's the same amount, but it has to be a given amount. So this amount is either given or it's the rest of a full amount, or whatever it is. Okay, so that's where I get my $1.25. So I want to make sure we kind of understood that. So technically, it would be preferred stock, there's 700 shares, so you'd multiply this by 700 shares. And for common stock, we have 6,000 shares, so you'd multiply this by 6,000. In total, if you just want to do it in a total amount, we have 6,700 shares. And we pay them $1.25 So in total, we are going to pay $8,375. Make sure you see where I got my outstanding shares from. This problem is pretty simple. We've only had 2 entries, right? We just sold stock, 1 preferred and 1 common. So pretty easy there. All right, let's put this entry in. Now we have the amount, $8,375. So the debit goes to dividends. We've done this before. Dividends is a contra equity account. This is October 1st, by the way, the date of declaration. So this is the date of declaration. I'll try to squeeze it in here. We do debit to dividends. Now, in prior chapters, we've just done debit, dividends, and credit cash because we just pay it right away. But now we're learning that you don't actually declare it and pay it all in the same day, that there's actually 3 steps to this. So instead of cash, we're going to do dividends payable. So dividends payable is a liability account. It's current liability. We're going to pay it within 1 month, within 30 days. Now on October 15th, which is the date of record, there's no entry. It's really just the day that we're going to get a list from the Securities Exchange Commission telling us who owns our shares of stock. And honestly, I'm not sure if we get the list from the SEC, the Securities Exchange, or if we would actually get the list from the exchange that we're on. So if we're on the New York Stock Exchange, Chicago Mercantile, or London, or NASDAQ, or whatever it is, maybe they send it. I'm not sure. That's something I should learn. Okay, so the date of payment. This is the day we actually cut the check. So the accountants, we've declared the dividend. We've got our list of people. That's the date of record. So we have this list. And now we're going to send the checks or send the electronic funds, whatever it is. So we'll do dividends payable. So you see how my dividends payable account's going to become 0, right? So that's 8,375. And then credit cash. So dividends payable. This new account, dividends payable, $8,375 on October 1st, and then we paid it on October 31st. So you see the account is 0. So that's all it is. It just acted like a middle account for us. Okay, that is dividends. Our next problem we're going to add to what we've learned so far, we're going to add treasury stock. So treasury stock is when an organization decides to go into the market themselves and buy back their own shares of stock. They buy back their own shares of stock. So let's write that down. Treasury stock is when, in this case, it's finishing touches. So the corporation buys back its own shares of stock. So if I buy someone else's stock, because a corporation I can buy other companies. If I buy other stock, that's an investment. But if I buy back my own stock, it's treasury stock. And there's different reasons why we buy our own stock. But let me go ahead and create this again. So we need to keep track of our shares outstanding. So remember, this is actually shares, not dollars. So shares, better write that down. Okay, we're going to keep track of common and preferred. And this time, we're also going to keep track of treasury. Treasury, again, is when we've bought back ourselves. And then you can sell it back again. So that's exactly what's going to happen here. Okay, so I kind of tried to make this problem go a little bit faster for us because we already know these entries. But the first one is January 2nd. We are going to sell 100 shares of common stock, and we do have a par value. I have to read this, sorry. Let me go back up here to the top. Let's read over this. Finishing Touches has 2 shares of common stock, or 2 shares of stock authorized, sorry. They have preferred and they have common. So the common is $1 par, and the preferred is 8%, $10. That's my preferred. Okay, it is my first year of operations, so that's important. Make sure you read over that. First year means I had 0 to start with. So beginning balance is 0 on all of these shares of stock. My first year. Okay, so we're just going to draw a line because I'm not going to be able to line that up right. Okay, now I've sold on January 2nd. I sold common stock. It does have a par value. So I need to make sure to include that in this entry. It does have a $1 par. So for my calculations for this first one, selling 100,000 shares, I'm selling them at $35 a share. That's my sales price. So that means I have $3,500,000 of cash. Now the amount that I'm going to put in the common stock account, 100,000 shares times $1 par. I like to put this in a different color. Par. So this entry would be $100,000 into the common stock account. And then the rest goes into PIC, and that is $34 a share times 100,000 shares, so $3,400,000. So that will go into the to the PIC account. Okay, so I want to first and foremost, because I almost forgot last time, was write it down up here in the number of shares outstanding. So under common, it is January 2nd. I have 100,000 shares. These are not dollars, so do not put a dollar sign here. These are shares. So 100,000 shares are outstanding. And the next thing I want to do, I know they don't tell us to do it for this problem, but trust me, we're going to need it in just a second. I'm going to do some T accounts. So off to the side here, I'm going to do a common stock. I know I'm going to need a preferred stock in just a minute, so I might as well just write this one in too. Preferred stock. And then I'm also going to do a PIC account. Okay, let's put these entries in. So common is $100,000. And preferred, or PIC, I'm sorry, is 3.4 million. I'm not doing cash. We don't need to keep track of cash. Okay, February 6th, we are going to sell 3,000 shares of the preferred stock. So let's zoom in here. And we're going to sell it for $11 a share. So 3,000 shares times $11, that's the sales price. So that is $33,000. That's the cash. Debit to cash. Cash coming in. Now those 3,000 shares times the par value, par is $10 for preferred stock. So it's $10 par. That is going to total $30,000 for my credit to preferred stock. And that leaves me with the 3,000 shares at $1 each, because that's the rest. So that's $3,000 for PIC, paid in capital, additional paid in capital. All right, let me put these over here in my accounts. So for preferred stock, it's $30,000. For PIC, it's $3,000. And then, don't forget, right up above here, let's write in the number of shares. I just sold 3,000 shares under preferred. So 3,000 shares. And that was on February 6th, I think. The date really doesn't matter up here. I just need to keep track of the number of shares. Okay. Awesome. All right. We've done this. We've done that. The new thing, on September 10th, we are going to purchase our own shares of stock. our own shares of stock. So when we buy, and it's common, we buy our own common stock. When we buy our own stock, this is called treasury stock. So I'm going to do a T account. This one's going to be a little bit bigger because we're going to focus on it. This is treasury stock. And it's called treasury stock because once you buy it, the piece of paper then goes into your treasury. You actually keep it. What's important about treasury stock is what goes in it must come out. So, oh, and I forgot to tell you, it is a equity account, but it's a contra equity. So that means it's going to have a normal debit balance. And the thing about this account is that we want to make sure when we buy back our treasury stock and then we sell it again, this account will eventually be zero because we will buy our stock, sell it, buy our stock, sell it. And it might happen in different lump sums like we're going to see for this problem. But this account won't ever have a remaining balance unless we have shares of stock. So that's why I say for this account, what goes in must come out. So what goes in must come out. And I'll show you that in just a second. Okay, so let's start with our first entry. It's September 10th, and we are purchasing 11,000 shares for $40 a share. So the entry would be debit to treasury stock. Contra equity debit, that means we're increasing it. It's 11,000 shares. And multiply it just by the amount that we paid. So $40. Now, this $40, it's important. I'm going to make it blue. Now, I did not deal with par. When it comes to treasury stock transactions, I don't worry about par at all. So par is not my focus. Instead, my focus becomes what goes in must come out, right? So the amount, when you multiply it, is $440,000. And of course, we're buying the stock, right? So it's credit to cash. So cash is going down. So what's happening is over here in my treasury stock account, I'm going to do my debit. It's 440,000. And I'm going, and it's September 10th. And I'm going to write off to the side in blue, different color here. This was $40. Because what goes in must come out. So it's going in at $40, and when I sell it, it's got to come out at $40. Okay, what does that mean? Why do I keep saying that, right? It's very strange. Well, let's look at the next transaction. On December 15th, we now are going to sell some of those shares of treasury stock. So we've got, of course, cash. We're going to collect cash. We're selling... So we'll take those 5,500 shares that we're going to sell back, and we're selling them at $45. So of course we got to use that sales price, $45. This is to determine cash. So when we multiply this out, we're getting in cash $247,500. But the entry to treasury stock cannot be $45. The entry to treasury stock needs to be 5,500 shares times $40. Remember, what goes in must come out. So I've got to use this starting point, this amount, the $40, to do my entry. And that would be for $220,000. I'm actually selling half of those treasury stocks. Okay. Okay, so now that we sold, or we bought back some of our own stock, up here where we're keeping track of the shares outstanding, I need to subtract from the common stock, I'm going to subtract 11,000 because I'm buying those shares of stock back. And this is September 10th. And I'm subtracting them from the common column, and then I'm going to come over here to the treasury stock column, and I'm going to add them. because I'm actually increasing my treasury stock, the number of shares I have sitting over there. So now the next entry on December 15th, I'm going to resell 5,500 of those shares of stock. So half of them, exactly half. Now the entry for cash, of course, for this problem will be really simple. December 15th, debit cash, you're receiving cash, 5,500 shares times the amount you sold them for, $45 a share. That's the sales price. So $247,500. Simple, right? But when I go to do the treasury stock, to decrease my treasury stock, can't do $45. So I'll still do my number of shares, 5,500. I can't do 45 because what goes in must come out, right? Oops, sorry, I just wrote the wrong amount and I wanted to change to this color. It's got to be $40 a share. What goes in must come out. So the amount that it went in at, $40, it has to come out at $40. So for this entry, I'll do treasury stock credit. That's reducing my treasury stock. Remember, treasury stock is a contra equity. So this is decreasing, and on my last entry, increased it, right? So this time it will be $220,000. And if I come over here to the treasury stock account, that's exactly what it will look like. On December 15th, 2,200, and see it's a credit, which is reducing it. It's reducing this account. So there's my $40. That way I can keep track, make sure that what goes in must come out. Okay, my entry's not balanced, right? Do you see this? My debit and credit, I've got cash and treasury stock, and it doesn't balance. So the difference will go to pick. And the difference is $27,500. It's just the difference, but you can write it out if you want to make sure to know how to get that number. It's $5. It's the rest, whatever's left. So we don't have a par value for treasury stock, but we do have I'm going to say set value. Whatever it goes in as, it has to come out at that amount. So in our case, it's this $40, this amount I wrote in blue. That way I can keep track and I'll know the balance in this T account right now is debit, $220,000, that's the balance. And I'll just divide that by $40 and that will tell me how many shares are sitting there. Okay, let me put in the pick account. So there's my pick T account. Let me zoom in. Kind of hard to see, but I added that. I know I didn't do any dates here, but here's the dates for these if you want them. And there we go. And the value in this pick account, just in case we want to have a value, we need it for our next problem, but the value here is $3,430,500. So I've kind of balanced out all of my T accounts. Okay, I was working my way up to the top of this problem because now that I sold back, they say resell some of my shares, I need to write that down in my shares outstanding. So on 12/15, I sold back out there. I sold these pieces of paper, sold 5,500 shares. So this is increasing this account. And on 12/15 over here for the treasury, I just said increasing this account. I didn't mean to call it account. It's a column. I'm just keeping track of the shares. Over here in the treasury stock, I am going to decrease the shares, 5,500. And let's just total this out. Treasury stock has 5,500 shares left, right? And these are shares outstanding. That means that's the number of shares. In treasury, it's not really outstanding. It's what we own. But they are technically considered still outstanding because they have been sold. Preferred, we have 3,000 shares outstanding. And then over here, this one's a little harder, but you'll calculate this one. It is 94,500 shares. So I took the 100,000 minus 11,000, add 5,500. That's how we get to the 94,500 shares. Okay, Notice that my common stock T account still has $100,000 in it. So the par value in that T account is $1, but I can't see in this T account the number of shares outstanding because of treasury stock. So I couldn't just take the $100,000 that's in this T account and divide it by $1, because that would make me think there's 100,000 shares, but there's not. There's 94,500 shares out there and 5,500 shares in my treasury stock. Now in total that's 100,000 shares, but they're in two different places. So preferred stock, I can easily just divide this by my par and I can see the number of shares outstanding. That one's easier to see. Okay, but I still need to keep track. That's why I did this little table in red there. I need to keep track of the number of shares outstanding. This problem doesn't make me do it, but if they were to have me declare a dividend at this point, I would need to know the number of shares outstanding in order to declare it. So, okay. Now, continuing with this problem, they've asked us to do a balance sheet, the stockholders' equity section of the balance sheet. So we're going to take those values, those totals that I just did in my T accounts, and bring them over here, and we'll calculate retained earnings. So this is a big, important step, definitely a hard step. I couldn't imagine trying to teach this to you in the beginning of the semester, but just think you're 10 chapters smarter, and this is a tough topic. I mean, some of these words are not words you would use in your everyday speaking or typing or anything, right? But you're going to be able to do this by the time we end. And my poor dog is really having a rough time today. Somebody is doing something nearby, and it's not making her happy. Okay, so in the equity section of the balance sheet, so this is the balance sheet, right? And this is as of year year 4, we call it, right? We would include here in the stockholders' equity section our stock. Now we have common and preferred. So what order do you think they should be listed? Preferred should be first. So we're going to list preferred stock first. And the value of that from the T account in the last page is $30,000. I didn't total that T account because there was only one entry. Same thing with common stock. There was only one entry there, but it's 100,000. Now, technically, on the balance sheet, either here or in the footnotes, we would include how many shares are outstanding. So we would say 3,000 shares, $10 par. I think it was 8%. I can't remember. I'm not sure on that. Here was 100,000 shares, but only 94,500 are outstanding, dollar par. We'd have a lot of information here. You don't have to for this problem. The other thing that needs to be listed in this paid in capital area is the PIC account. So the additional paid in capital. I'm just going to abbreviate that. And that was the $3,430,500. So all of these, see prior page T accounts. Of course, you know, the T accounts go to a trial balance, which then go to the financial statements technically. But the balances come from the T accounts. Okay, so total paid in capital, if we add these three amounts up, 30,000, 100,000, and this 3.4 million, that gets us to $3,560,500. Now this is the equity section. So I've got my stock in the PIC account. Those all go together. But I also need to remember my retained earnings. And what about treasury stock? Treasury stock didn't go in the capital account, or the capital area, did it? So let's do retained earnings next. So retained earnings, we're actually going to have to calculate this one. We haven't done it yet. So if I look at a T account for retained earnings, it would look like this. Earnings that have been retained, right? We've done retained earnings before, but this will be a good review. Okay, so retained earnings has a beginning balance, credit balance, and in this case, it's a new company, so it's 0. Now, technically what happens, what we learned in chapter 3, is that we close revenue and we close expenses. Remember RED? We'd close all of these accounts here. So I'd have revenue and expenses. In this problem, they didn't give us those amounts separate. Instead, they gave us net income. Now, net income, we know, would be revenues minus expenses. So I'm going to take this net income amount and I'm going to put it on the credit side because it's going to increase, right? Net income is earnings. So, and I just want to write this out with my little red, that this would be the R and the E. It's technically R minus D or E, revenue minus expenses, right? So there's my RE. Remember, retained earnings, we close the RED accounts here. So where's the D? Dividends. They give it to us in this problem. Dividends. They say that there's $94,500, which is $1 per share for common, and then $2,400 for preferred. And if I remember correctly, preferred was 8%, $10 par. So remember, $10 par times 8%, that would give us $8 per share. And we had 3,000 shares, so that equals $2,400 in total, right? Did I do that right? No, 8% would be 80 cents a share. Okay, that makes sense, right? 10 times 8%. Yeah, it's 80 cents a share. Sorry, let me fix that real quick. Otherwise it doesn't equal, does it? There we go. Okay. I'll zoom in so we can see it better. 80 cents per share. Okay, so we're just verifying that they did their math correctly, right? $2,400. So for dividends, I've got, this gets subtracted. Dividends of $94,500. That's the common. So this is common stock dividends and preferred stock dividends. I'd subtract those from this account, and there's my D. So RED. Remember, we closed the red accounts. RED. Okay, so let's look at this. If we do the math, I've got 0 to start, plus 160,000, minus 94,500, minus 2,400. In total, my balance in this account is 63,100. That's my balance. It should be on the credit side. If it's not, we've got a problem. It means you didn't retain earnings. Okay. All right, everything looks good so far on this statement of equity except treasury stock. I still need to include that. Treasury stock is a contra equity. So yes, it's still included with the equity accounts. However, because it is a contra equity, it is subtracted. If we remember correctly from the other side, it had a debit balance. So a debit balance, everything else here is a credit balance. A debit balance needs to be subtracted. So the account total was $220,000. Remember, we sold back half of it. We still have half. It is subtracted. So I've got that as a negative number. Let me zoom in. There we go. So total stockholders' equity. Start with that paid in capital. $3,560,500. There's a line here. And then add retained earnings. And then subtract treasury stock. That will give us a total of $3,403,600. When I take capital plus retained earnings minus treasury. That is my total stockholders' equity. Okay, for this next problem, we are going to put everything together that we've learned so far and pay dividends. So that's going to be an added part to this. Okay, so again, I need to keep track, very important, I keep track of the number of shares outstanding. So in this one, I do have treasury stock, but I don't have preferred. That's right. Okay, just want to make sure I had that right. So I'm going to do common and treasury. No preferred for this one. Okay. All right, we'll keep track of those shares outstanding. Okay, so Power Drive, they do some golf apparel stuff. Let's see, what else do we know? They have 100,000 shares of common stock outstanding already as of the beginning. So I'm going to add that in right now, the beginning balance. I have 100,000 shares. That's my beginning balance. Remember, these aren't dollars, these are shares. Okay, and here's the following transactions. So I kind of started us out with it already written out a little bit here. We sold some shares of stock. So I sold 65,000 shares at $62. There it is, $62. That's my sales price. So in total, that is $4,030,000. Now, yes, this common stock does have a par value. It is $1. So that means I'll take those 62,000 shares and I'll multiply it by the dollar par. And that's $62,000. That will be the credit to the common stock T account. Now, I don't need to keep track of the T account this time. And the rest, which is $61, right? Price was $62, par. The rest is $61, and that is into the PIC account, $3,965,000. Again, I'm not doing a T account this time. I don't need to keep track of these. This is March 1st. So up here where I'm keeping track of my number of shares, it's March 1st. I'm going to add another 65,000 shares under the common stock column. Okay, let's buy some treasury stock. So we're buying back our own shares of stock, right? So again, this is contra equity. It means it's going to be on the debit side. So contra equity. So I'm going to see everything on the debit side, and what goes in must come out. So that will be the big deal here, remember? Okay, so I am purchasing 6,000 shares. So I'm going to buy 6,000 of my own shares of stock. It's May 10th. 6,000 shares. I am buying them at $65 a share. So it is $390,000. And of course, we're debiting treasury stock and crediting cash. That's how you got to buy them, right? All right, let's use green for this one this time. So $65 is going to be our, what goes in must come out, right? So let's see, let me do my total. $390,000 is my debit. And this is on 5/10. And then I'm just going to, in green next to it, I'm just going to keep track of the $65. That's really important. And then up here where I'm keeping track of my number of shares outstanding, it's May 10th. I need to subtract 6,000 shares on the common stock column and then include an additional 6,000 shares in the treasury stock column. All right, everything looks good, right? Let's zoom back in here and the number of shares outstanding. My next entry is going to have me declare a cash dividend. So what I need to do is know how many shares are outstanding. So I'm going to go ahead and total this. I'm going to just draw a line. Under the common column, I see that my balance would be 159,000 shares outstanding. And under the treasury stock column, it's 6,000 shares outstanding. I kind of paused for a minute. They're technically outstanding, but we don't pay dividends on them. They are in our treasury. So they're included there and they're considered outstanding, but they're not to be paid dividends on. And they actually give us that tip right here. Dividends are not paid on treasury stock. Okay, so it is June 1st and we're declaring a dividend. And the dividend is what? $2 per share. Okay, so June 1st, the date of declaration, right? I don't know what color I haven't used yet, so we'll just put it here. Okay, the date we declare it. So what we do for this entry is debit dividends and credit dividends payable. And then we just have to calculate the amount. So how many shares of common stock are outstanding? That was the 159,000 shares. So 159,000 shares. That was common stock outstanding. And we got that from our little table where we were keeping track, right? Of course, you could go back and have to calculate it, add and subtract as you go. And now it's multiply it by $2 per share. We're going to pay out $318,000 in dividends. So my entry will be 318,000 debit to dividends, 318,000 credit to dividends payable. The date of record is June 15th. We don't do a journal entry on that date. They actually don't even ask you to do that for this problem. But remember, no entry on June 15th if you were to see that. Now on July 1st, we'll actually pay the dividends. So my entry here, this is the payment entry. Pretty easy. We know the amount. It's already been calculated. We debit to dividends payable. That will zero out this account, $318,000. So you see what we credited it, now we're debiting it, and then we credit cash, $318,000. That's our payment entry. Okay, one last entry. We're going to resell some of those shares of treasury stock. So it is October 21st. October 21st. We're going to sell, so cash, debit cash. We're going to receive some money. Okay, let's just do the full amount. So it was 3,000 shares, and we're selling them for $70 a share. That's the sales price. So 3 times 7, 21, so $210,000 will be my debit to cash. That's the cash received. Now, what I want to do is credit treasury stock, because when I credit treasury stock, that actually reduces this account, right? We increase this account up here on May 10th, and now we're going to decrease it on October 21st. My problem is I cannot multiply this by the sales price. I have to multiply it by the amount that I originally bought it for. So my $65. And that total is $195,000. That leaves me with basically, okay, I'm going to try to be careful of this word here, but I'm going to say profit. The difference is $5. That's the rest. And it's kind of like how much money you made on this, because you bought back your stock and then you resold it and kind of made some money. You're not really supposed to make money on your own shares of stock, but as long as it's not with insider trading information, that's a hard thing to prove here. However, let's not get into that. Okay, so October 21st, I can see my T account here. I'll zoom in. My T account here, I reduced it by $195,000. I credited it, right? So remember, in this T account, I increase with debits, decrease with credits. So my new balance in this account will be $195. Your book likes to sell exactly half of the treasury stock every time. I kind of wish it was something different, but that's okay. We understand. So this is on 10/21 up here, where I'm keeping track of my outstanding shares. I've now sold 3,000 shares back into the market. So I've got to add that in my common stock column, and I take away from my treasury stock column because I just got rid of them, right? And let's show that in parentheses. So if I were now to need to know how many shares are outstanding, it'd be 162,000 for common and 3,000 for treasury stock. Okay, that's it for this problem. Okay, the next problem has us prepare a statement of stockholders' equity. And I'm going to be honest with you, the statement of stockholders' equity is different in I shouldn't say every, but in real life it is a little different. But that's okay. This is the way they taught it, and I actually really like couple important things about it, and one that I'm going to note on here. So I'm going to kind of work through this a little quick. You can always slow down the video if I'm talking too fast, of course. Okay, so what I have is Power Drive Corporation, and these are the journal entries that we just did. So same company we just did, we are actually putting these journal entries in the proper column. So do you remember the statement of equity that we used to do, way long time ago in chapter 1? Do you remember that? Chapter 1, 2, and 3? And we had 2 columns and then a total. We had common stock and retained earnings. Do you remember that? So that was in chapters 1, 2, and 3. Now we're going to have common, maybe preferred, and PIK, of course. And then we'll have retained earnings, and then we'll have that contra treasury stock account. So this account here is like a negative account. And then, of course, the total. So you see how this statement has gotten much bigger than what we used to use, right? Okay, they did put the balances in for us. Remember, this company had common stock to start with, so of course we've got common and PIK to go along with it. And of course we've got retained earnings balance as well. Okay, so if we remember correctly, these entries, and I can put the dates on here real quick. These were the entries. We issued stock on March 1st, and then we purchased treasury stock. We declared some dividends, paid the dividends, and then resold some treasury stock. So those were our entries. Okay, we issued common stock. It was $65,000 that goes into the T account because remember it's only par. But in the paid in capital account, we had the rest, which was $3,965,000. So I'll zoom in a little bit there. There we go. And then we had nothing in retained earnings, treasury. And so in total for stockholders' equity, it was $4,030,000. Next entry, purchase treasury stock. So we scooch on down to the treasury stock column, and we'll include $390,000 here. And when we purchased the treasury stock, here's what happened. The treasury stock T account went up, but it goes up with a debit, and that overall is negative. So in this statement of equity, we're looking at the equity accounts, which are credit balance accounts. So when this account goes up, treasury stock, it actually is going to be a negative balance here. And then, of course, that's the total, negative $390,000. We declared dividends. Dividends are also a negative transaction because it's a debit balance contra equity account. So $318,000 negative, and that goes in the retained earnings column. Remember that? Dividends and net income go in that retained earnings column. Payment of dividends. The payment of dividends doesn't actually go on this statement. Of course, they include it in a line, but it wouldn't. It would technically need to be swiped on here. The declaring of the dividend is the only entry that affected an equity account. We did equity and then liability, and actually paying the entry was liability in an asset account. Nothing to do with equity. So this one has nothing. Reselling that treasury stock. So that one would be an increase of $195,000 right here to that treasury stock column. And it's an increase. So it actually is reducing my treasury stock account with a credit, but a credit is good in terms of this entire statement. So 195, oh, and then the PIK, sorry, don't forget the paid in capital, 15,000. And so in total, it's 210,000. Nope, that should be in total. It should be no, that's right, 210,000. You know what? Yes, I'm thinking of a different problem where it was 220, remember? Okay, net income. They did give it to us here. Net income for this problem is $700,000. So remember, net income, that gets added into the retained earnings column. So 700,000 there. Okay, and I think Connect will do this automatically for you, but these totals will pop in, and then I'll tell you the note that I wanted to give you on this problem. The balance in the treasury stock is still negative because we still have treasury stock. There we go. Did I write that right? Okay, there we go. There's all the totals that just popped in there. Okay, now in this common stock, and I know I've mentioned this another time, so it's kind of a little bit redundant, but in this common stock T account, in this account, we do not subtract the value of treasury stock. This account keeps track of par value of all common stock that has been sold. So even if it was sold once and then we purchased it and then we sold it, whatever, it's the first time sale. Any repurchased treasury stock, any resold treasury stock is not included. So treasury stock purchased and sold is not included. So I can take this amount, divide it by the par value, and that will just tell me how many shares of stock have been sold at any given time. So there was 2 transactions, and I would see those. It does not tell me the treasury stock. That's different. That's why we kept in that red box, where I kept keeping track of the number of shares outstanding, because I needed that to be able to declare the dividends and calculate it. So, all right, that's it for chapter 10. If you have any questions at all, please email me. Bye now.